Market seemingly positioning for a little bit of a deceleration type growth story, also a patient Fed, and this general idea of, look, liquidity beneficiaries, reliable growth, but not necessarily accelerating. So that feeds you into the Nasdaq 100. I think where we are right now is after such a long streak, 7 straight record closes for the S&P. The Nasdaq 100, just on a technical level, is basically as overbought as it's been since last September. It's not as stretched as last September, but it's just getting there. And I think when you have these jobs day levitations, it's sometimes a little bit of a short-term, kind of we got there type moment, as opposed to it being really the start of a new macro move. But strong trends tend to eventually bring more buying behind them. So I don't think any pullback from here would be all that significant necessarily.
Victoria, what's your view, and particularly those big cap Nasdaq stocks, as Mike said, that have enjoyed some very good momentum of late?
Well, we've always liked those names, and obviously when we are having these rotations between growth and value, and the question as to whether yields move higher or lower, we've seen them transition. They've been leaders and they've been the laggards of the market. With yields coming back down and some of the inflation concerns diminishing over the last week or so, then I think it makes sense that we're seeing some of these names continue to do well. We actually own the majority of those large cap tech names in our portfolio, and we continue to hold them. We see the longer term trends being positive for those names, and we still think that even though there's the continued reopening trade and value and cyclical continue to do well, we like having some of these growth names in the portfolio, and we'll continue to do so for now.
No matter what the valuation, Victoria, at what point do you start to wonder about that as the Nasdaq does catch up with the broader market?
Obviously, Sarah, we have earnings coming up, and so we're going to see some of these PEs start to shift a little bit. We're looking at peak earnings growth, I think, coming up here for the second quarter. You're looking at, I think, 60% is the expectations right now, and that's going to come down the rest of the year. And Mike was talking about it a moment ago. We're looking at earnings coming down to around low 20s in the third quarter and then down in the mid-teens for the fourth quarter. Still strong, still solid, but we're starting to see peak right now and things come down a little bit. So maybe if you don't own some of these names, we could see valuations start to pull back just a little bit over the rest of the year. That would be an opportunity for you to go in. But even a name like NVIDIA that we like that continues to do well, we would go ahead and add it. We added it not that long to our portfolio, not that long ago, because we continue to see an uptrend.
Greg, do you still fear that if there are hawkish comments over the summer at Jackson Hole or wherever it may be, that the market will get spooked, or do you think it's already kind of expecting that and pricing that in and trusting Jay Powell at the moment?
I don't think that the market is pricing it in, right? And when we think about growth in particular, right, growth had 3 real headline headwinds that we were cautious of, and we're decimating one right now. The companies are doing that, and that was in the earnings power. Was what we saw last year a COVID-induced bump, or was that real secular growth? And I think the market is proving, the companies are proving that it was the latter. And so we saw cloud up 50% in some cases, 30% in others. We see digital advertising up. We see software up. We see hardware up. And so I think as we get through these quarters and the companies prove that last year was not just COVID-induced bump, that decimates one of the headwinds. We talked about inflation. As the inflation fears come in a little bit, and as the Fed demonstrates an unwillingness to address it to some degree, then growth in tech will do what it does. And in the lack of that headwind, they'll continue to get a tailwind. And then lastly, something important happened this week. We got some relief on that last headwind, which was government intervention or government action. And the judicial laid down a line in the sand and said, we need more evidence. We need more substance if we're going to consider anti-competitive behavior or we're going to consider monopoly power than the anecdotal or diatribes from our elected officials. And so growth in tech will continue to feel a tailwind into Jackson Hole. Now, the jobs number, I think, means that the Fed can turn its attention to its other mandate of inflation. And while, yes, wage growth was less than we expected and abated some concerns, there are other parts to this, right? Commodities PPI is in historical territory. The month-over-month numbers in CPI and PCE are in 30 and 40-year historical territory. And so that will need to be addressed, and I'll need to see next month's data, but I suspect that we may see a change in posture in the Fed at Jackson Hole, and that would present a headwind for the general market.
Shepard Smith here. Thanks for watching CNBC on YouTube.